reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, for a recap on the first half of 2023. We'll also get his outlook for the second half. Steve, it's great to see you as always. Welcome back to Trade Talks. And here we are. It's weekend, quarter end, first half end, and there was a lot that took place in the first half of 2023.
Oh yeah, this was this quarter and this half overall have been stellar, especially for the indices that Nasdaq hosts. I mean, Nasdaq was the real winner. The Nasdaq 100, has put together two remarkably good double-digit upticks. And we're ending this quarter on a high note. Yes, much has been made about the leadership of the mega cap techs, and we can. We've discussed how that does pose potentially a risk if things turn around. But in the meantime, we've seen markets kind of broaden out from that early leadership, and we're really, this has been a solid quarter, pretty much no matter where you've been in U.S. equities.
Yeah, I mean, see, that really has been the case, of course, propelled by the excitement that we've seen in AI. It makes you wonder if that wasn't part of the market narrative, what it would have looked like, because a lot of that leadership did come from the names in the semiconductor space that had the exposure to AI. And of course, the mega caps, as you had mentioned, as you think about the second half of 2023, and yes, stocks did climb the wall of worry. A lot of the same risks exist in the second half as they did in the first half. So what's your outlook there? Where should market participants be focusing?
Well, there's a few things. I mean, first and foremost, we have second quarter earnings season begins in 2 weeks, and we really, that you as a market participant, you have to be cognizant of earnings. And I know sometimes it gets, tedious to hear about earnings season. Oh gosh, they have, the same narrative every quarter. But yes, it's important because ultimately when you buy a stock, you're buying an earnings stream. You're buying a stream of earnings and cash flows and dividends and all that other nice stuff. And so you have to know, what the company's income statement, what their balance sheet, and what their cash flow statement look like, and are they meeting expectations? And so one can argue that because a lot of the rally that we've seen so far this year has been the result of multiple expansion. And by that, I'm referring to the PE multiple. So the price has been moving up faster than the earnings. At some point you want to know whether the earnings, or at least the earnings projections, are going to catch up to the price appreciation that we've seen. You mentioned, the semiconductor stocks and AI. NVIDIA was pretty much the poster child this year, but what really got things moving for NVIDIA and dragged up a lot of the sector was that they put out some monster guidance along with in April when they reported. It's hard to see them, upping that as an encore. And I'm not saying that as a specific stock call. I don't have my own independent estimate on NVIDIA, but that's the point. Is we got some great guidance, and I think there was some concern that earnings guidance was going to be light, and it wasn't. And so let's see now that the bar has been raised. Can these companies come over the higher bar of expectations? And we'll know soon enough.
Yeah, I also think we have to remember that they were so beaten up at the end of 2022. So, I mean, it almost was somewhat of a value play in the beginning of the year as well, because they were beaten up so much. So even though it might look like the index is up by double-digit percents, it also came back from a deficit. So I think we need to keep that in mind as well. But to your point, you have to be earnings, and then your guidance has to further support these multiples that they've earned. I mean, I think guidance really is the key.
Oh, absolutely. I think companies are, one of the things you always see during earnings season is somewhere in financial media, there'll be a chart or, a table that says, some high number of percentage of stocks have beaten their earnings, 80% or whatever. I think that's as much a testament to management's ability to manage the analysts as much as it is to manage their businesses. At some level, they're very good at managing the guidance that they put out and get the analysts sort of, they sort of herd them into line with a number that they can usually beat. So I don't put too much stock in the idea that, okay, X number of companies beat their earnings. I guess I would be worried if that number wasn't a very high number, 75% plus, then maybe people are doing something wrong. But the real key, as you note, is guidance. What do we see? The bond market is screaming recession at us. We have a 2's10 inversion. The 2-year yield is is higher than the 10-year yield by over a percentage point, and that's a magnitude that really just screams recession. But equities are not seeing it, and to be fair, we're not really seeing it from the numbers. And so, I think it's reasonable for equity investors to wonder, is there going to be a recession, and if so, when, and what's it going to do to my favorite stocks? And so this is one of the times where you get some clarity into what management perceives is the economic climate and how it will affect the companies that they manage.
Yeah, and of course we have to think about the Fed as well. I mean, as much as the equity market wants to fight what the Fed is actually saying, they are not changing course. They were very explicit in the fact that what matters is core, not headline numbers. It's all about core, which is well over 4%, right?
Yep.
And it doesn't sound as if they're going to shift strategy anytime soon.
It doesn't behoove them to say anything other than continue the tone that they are going to be at least biased toward raising rates. As you know, the PCE core deflator came out today. That's the preferred number. It still has a 4 handle, and yes, it's coming down. But if you annualize the last 3 months, which a lot of people like to do, you still come up with something around 4. We don't have to be a mathematician to know that that is above 2, which is where the Fed wants to be. And so how do we get down there? Well, we're not going to get there if the Fed really, and other global central banks, basically come out and say, oh yeah, we're making great progress. We're going to take our eye off the ball. Maybe it's time to ease up here. They're not going to change that rhetoric until or unless circumstances dictate, and that is one of 2 things. Either the economy weakens or inflation comes down to something approaching, let's call it a 2 handle. I'm not going to say necessarily 2.0. But until that happens, you did have Bostic come out to say, well, maybe we don't need to raise rates anymore. But I guarantee you they will not be talking about, it's going to be how much and whether to raise rates, not any talk about when or whether to cut them, not for any time soon, until you really start to see inflation, core inflation, get washed out of the system. And we're not there yet.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.